So, Zia, I've got something pretty wild for you today. I have a number. You ready for it?
Okay, yeah, hit me.
$650 million.
Wow. Okay, that is a lot of zeros. What is that for?
That, my friend, is what Microsoft paid for Inflection AI. Except, and this is the really crazy part, they didn't actually buy the company.
Wait, what? Hold on. How do you pay $650 million and not buy the company? That doesn't make any sense.
Right? It's wild. So what they did was they hired the co-founder, this guy Mustafa Suleiman. They brought over most of the engineering team and they licensed the technology. But the company itself, the legal entity, the cap table, all the early investors who were, hoping for this massive payout,
They were just left holding the bag.
totally left holding the bag. Well, okay, maybe a small bag. They got a consolation prize, like a tidy multiple on paper, but it was absolutely nothing like the outcome they signed up for. And this isn't just some weird one-off thing. This is the new playbook. People on the inside are calling it Halo. It stands for Hire and License Out. We're seeing it everywhere. Google, other big players, they're doing these almost identical buy everything but the company deals for billions.
So, big tech basically figured out a loophole to acquire AI startups without, actually acquiring them.
They totally did. They sidestepped the classic merger reviews. They have the FTC breathing down their necks way less. The EU's Digital Markets Act, it puts a much smaller target on their back. I mean, it's genius, really. It's also completely brutal. And if you're a founder out there listening, you absolutely need to understand what this means for your exit.
Because that big headline number, it doesn't mean what you think it means.
Exactly. And that's just one of the three major buyer types that are circling AI startups right now. So today here on the AI Intel Brief, we are breaking down the whole picture, what I'm calling the Buyer Triad. You've got big tech, private equity, and sovereign wealth funds. Three totally different games, but they're all on the same hunting ground.
Okay, so let's dig into that. Let's start with the obvious one. Buyer number one, big tech.
All right, yeah, the strategic integrators, Microsoft, Google, Meta, Amazon,
The ones with the deepest pockets, right?
the deepest pockets and the biggest targets on their backs. See, you got to get this. For these companies, AI isn't just another product. It's the next computing platform. They are trying to control the entire stack. I'm talking from the custom silicon chips at the very bottom to the cloud infrastructure to the AI models themselves, all the way up to the apps you're using every single day.
So when they buy a company or halo a company, they're plugging holes in that stack.
Precisely. And the gap they are most desperate to fill right this second, it's what we call agentic workflows. Basically, AI that can actually do things, not just chat with you, actually execute tasks. I mean, look at Meta. They paid more than $2 billion for a company called Manus AI last month, a company that hadn't even been around that long. Why? Because Manus was way out in front on the doing problem. They were building agents that don't just talk, they take action across your entire digital ecosystem.
Whoa, hold on. $2 to $3 billion for a really young company? That seems super aggressive.
It's not aggressive, it's desperation. That's what it is. Because if you don't own that doing capability, someone else is going to embed it into their platform. And all of a sudden, your users just poof, don't need you anymore.
Okay, but what about antitrust? You mentioned the FTC, the DOJ. Aren't they supposed to be blocking these kinds of huge deals?
Oh, they're trying. They are absolutely trying. And that's a huge reason why the Halo playbook even exists. See, big tech realized that a traditional acquisition meant, months and months of scrutiny and a real risk of getting sued. So they engineered a workaround: hire the team, license the IP, and just leave the corporate shell behind.
So the regulators are basically watching the front door while big tech is sneaking in through the window.
That's a perfect way to put it. And for founders, this whole thing creates a really weird dynamic. If your biggest asset is your team, like you've got these elite AI engineers that Google or Microsoft would kill for, big tech will come knocking. But the deal isn't really about your company. It's all about your people. Your equity, that's a secondary concern.
Which brings us back to that cap table problem you mentioned.
Exactly. We'll get to the scary math on that in a minute. But first, buyer number two,
All right, so who is buyer number two?
private equity. Firms like Thoma Bravo, Vista Equity. These guys are playing a completely different game.
Right, they're not trying to build these huge tech ecosystems.
Nope, not at all. They're engineering financial returns, pure and simple. And their playbook, it's beautiful in its simplicity, really. It's called the AI first roll-up.
Okay, walk me through it. What is an AI first roll up?
Okay, step one, you find a fragmented vertical market, something like accounting software, legal tech, healthcare SaaS, a space with lots of little players, but nobody is really dominant.
Classic roll up territory. Yeah.
Totally. Then step two, you acquire a bunch of these companies, 5, 10, whatever it takes to get some real scale. Step three, you integrate them all onto a single platform. And then step four, and this is the key, you deploy AI to automate absolutely everything.
Oh, I see. So you're taking what might be like a services business with really thin margins and turning it into a tech platform with fat margins.
Now you're getting it. Yes. A firm that was operating at, say, 15% margins, after a serious AI automation push, you can see those margins jump into the 30s or 40s, sometimes even higher if the stars align. And here's the flywheel effect. As you get more customers, you get more data. More data makes the AI better. Better AI attracts more customers. It compounds on itself.
Okay, so what are they paying for these kinds of companies?
The multiples are insane. We're talking 25 to 30 times EBITDA for the really premium deals. That's compared to maybe 6 to 8 times for a traditional SaaS company.
30 times? That's crazy. Public markets are trading at what, like 15 right now?
Right, but see, PE isn't paying for what the company is today. They're paying for what it becomes after they automate it. They're underwriting the future state. Thoma Bravo is doing this exact thing right now with Verint and Calabrio, merging them into this big AI-powered customer experience platform.
So, if you're a founder and you have like a vertical AI company, you've got sticky customers, solid revenue, but you're not sexy enough for Google.
PE is probably your most likely buyer. The exit isn't glamorous, it's all about EBITDA multiples, not hype, but it's real money. And honestly, for a lot of founders, that is the smart play.
Okay, buyer number 3. This is the one I'm actually most curious about. Sovereign wealth.
Yes, sovereign wealth funds. Saudi Arabia's PIF, the UAE's Mubadala, Singapore's GIC. And these guys, they're playing for entirely different stakes.
Yeah, they're not playing for like chips at a casino.
No, they are playing for their country's entire future. For the Gulf states especially, AI is the exit ramp from oil. It's about economic diversification, technological sovereignty. It's the foundation for whatever comes after the petroleum runs out.
So this isn't just a financial play for them.
Not at all. It's strategic. It's national. And they are writing massive checks to prove it. Get this. $46 billion deployed into AI in just the first 8 months of 2025 alone.
46 billion? Where is all that money going?
Well, mostly not to the early stage startups. It's really concentrating into the later stage already proven winners. Your OpenAIs, Anthropic, Databricks, the companies that are already at the frontier.
It's a flight to quality.
A big time flight to quality. And at the same time, they're building out infrastructure. I mean, PIF and the UAE's MGX fund, they are pouring billions into AI infrastructure and data centers. They get it. They understand that compute is the foundation. If you own the infrastructure, you have the leverage.
So, for a founder, what does a deal with a sovereign wealth fund even look like?
It looks like patient capital. These funds, they think in decades, not quarters. They are not going to pressure you for a quick exit. But, and this is super important, you're aligning your company with a nation's strategic objectives. And that has huge implications for your governance, for geopolitics, For who else you can even work with?
There are strings attached.
Very, very long strings. So the question isn't whether they want to invest in you, it's whether you want them as partners for the long haul.
All right, let's talk about the math now because you keep hinting at this cap table problem.
Okay, yes, this is the part that literally keeps founders up at night. And boards, they do not talk about it enough.
Hit me.
Okay, let's just say you're a founder. You've raised a few rounds of funding, a seed, a Series A, a Series B. By now, your ownership stake has probably been diluted down to, I don't know, maybe 20, 25%. That's totally normal.
Right, but that's still a big chunk of a potentially huge number if you exit big.
But here's the catch. It's not about your percentage. It's about something called liquidation preferences.
Okay, explain that to me like I'm 5.
Think of an exit like a waterfall. When the acquisition money comes in, it doesn't just flow evenly to everyone. No. It flows down through layers, and the investors with preferred stock, they get to drink first. They have what's called a preference stack, which is the total amount of money that has to go to them before anyone else sees a single dime.
So if you've raised, let's say, $28 million from investors.
You have a $28 million preference stack. Now, let's say you get an acquisition offer for $30 million. Sounds like a win, right? Big headline number, pop the champagne, write the press release.
But the math doesn't work out.
The math is a disaster. The first $28 million of that deal goes straight to the investors. The founders and the employees, they get to split what's left, maybe $2 million. And that's before transaction fees, before taxes, after 5 years of grinding.
That is absolutely brutal.
It's devastating. And in an Acqui-hire, that Halo deal we talked about, it's often even worse. The big headline price is mostly just retention packages for the key engineers. The underlying equity in the company can be effectively worthless. The whole cap table can just get wiped out.
So the question you should be asking isn't what's the acquisition price, it's what's left for us after the waterfall.
Exactly. And most founders, they don't even model this until it's way, way too late.
Okay, let's bring it home then. We've got 3 buyers, 3 totally different games. What is the big takeaway for everyone listening?
The takeaway is you have to know what you're actually selling. If your biggest asset is your amazing team, big tech might come calling, but they might just hollow you out with an acqui-hire. You have to understand that going in. If you're a vertical SaaS with really sticky customers, PE will pay you solid money based on EBITDA multiples, but you're giving up control. And if you're building at the frontier scale, sovereign wealth is patient capital for sure, but it comes with a lot of geopolitical baggage.
And what about the whole unicorn or busts mentality?
It's dead. That fantasy, it worked when everyone was just spraying money everywhere. But in 2026, it's actively dangerous to think that way. The founders who are going to win now are the ones who understand this buyer landscape and position themselves accordingly.
It's either a strategic landing or a wipeout.
That's the game now, and trust me, the buyers have done their homework.
All right, so we definitely want to hear from you all. If you're a founder, which of these buyer types scares you the most? If you're an investor, how are you advising your portfolio companies on this? Let us know in the comments.
And hey, if this episode of the AI Intel Brief made you rethink your exit strategy, do us a favor and smash that subscribe button. We go deep on AI markets every single week.